Hello everyone, welcome to IASbaba's Rapid Revision Series for Prelims 2021. This is session 48 and day 66. And the topics we have are Indian economy, basically the foreign issues. So these are the hot topics we are going to discuss. That is the OECD or the G20 two-pillar plan, then Bilateral Investment Treaty, then the Advanced Ruling Mechanism in GST, then Variable Capital Company, and the Insolvency and Bankruptcy Code, then the Data Localization, and the ITAT-Eid War, and then the independent directors, and then the sovereign gold bond scheme, and Uday Kotak committee on corporate governance. Now, coming to the first one, the OECD or G20 two-pillar plan. Why was it in news, friends? Because India and the majority of the members of OECD or G20 inclusive framework on BEPS or the base erosion and profit shifting. They have joined a new two-pillar plan to reform the international taxation rules. So, what is this base erosion and profit shifting, and what is this G20 inclusive framework on base erosion and profit shifting? We all know that. And now the key points are: the plan amounted to around 130 nations. Now it might be 139 countries. Then this is representing more than 90% of the global GDP. And the new framework seeks to address the tax challenges arising from the digitalization of economies. Yes, friends, we know that due to digitalization of economies, the place of business and place of establishment of business are being different, and there is no clarity between who is doing business where. So, in that context, the base erosion and profit shifting has become common, and this two-pillar plan aims to tackle that. And it also seeks to address the concern over cross-border profit shifting and to stop the treaty shopping. Friends, what is treaty shopping? It is that making use of a bilateral treaty between two nations to evade taxes, and even that is easier in the digitalization era. Now, what does the pillar 1 say? It is that it would reallocate some taxing rights over multinational enterprises from their home countries to the markets where they have business activities and earn profits. So, here you are shifting the profits of those companies from the place where they have been located to place where they are doing business actually. So, even though you don't have a plant there, even though you don't have an office there, even though you don't have any establishment there, but still if you are making profits from there, maybe via website, etc., if the customers are on that country, then your profits will be shifted to that country. Then, according to OECD, more than US dollars of 100 billion of profits are expected to be reallocated to market jurisdictions each year. So, rather than the owner's country, we are shifting it to the market's country or the customer's country. Then, pillar 2, it seeks to put a minimum standard tax rate among countries through a global minimum corporate tax rate currently proposed at 15%. So, wherever you do the business, everywhere the digital tax rate would be 15%. So, here if you do this, there will be no room for base erosion or profit shifting, because we know, friends, the base erosion and profit shifting breeds only when there is a difference in taxation. That is, if the service tax is 10% in India and if it is 5% in US, then you will show the most of profits in US rather than in India. But if they are equal, that is 15% everywhere, then even if you shift the profit, there will be of no use for you, because everywhere you have to pay the same percentage of tax. So, this is another aim of this two-pillar plan. Then, it is expected to generate an additional income of US dollars 150 billion in the tax revenues. So, when you are doing this one, this will also bring in revenues to the consumer nation or the market-oriented nations as well. So, this is the two-pillar plan. Now, come to next one, the Bilateral Investment Treaty. Friends, why was it in news? Because there have been calls to review India's model bilateral investment treaty since 2016. So, in 2016, the new model BIT was formed, and this has been in the loggerheads with several nations, and there are being international voices to reform India's bilateral investment treaty back to the originality or to come up with any new forms. Now, about BIT, it is an agreement establishing the terms and conditions of private investment of one country in another country. So, bilateral investment treaty mainly looks after investments, and that too the private investments. Then, BITs include fair and equitable treatment. So, if any investor who is foreigner, he has to be treated just like we are treating a national or a domestic investor. Then, protection from expropriation. Friends, what is expropriation? That is the government taking over your profits for the sake of public interest. So in this bilateral investment treaty, there will be protection for the foreign investors, and their money will not be taken by the government whenever the government wants. Rather, there will be a separate procedure, or outrightly they will be forbid or avoided from taking those profits that was earned by foreign investors for the public interest. Then free transfer of means and full protection and security. Yes, when you are doing investment trade, etc., you need security and full transfer of means. You need not be paying any deductions or any expropriations or others. Then come to the next one, an alternative dispute resolution through ISCID, that is International Center for Settlement of Investment Disputes, will be facilitated. So if there are any disputes between the foreign investor and the domestic investors, so where these foreign investors have to go, in their original country or their invested country? No, they will be having one stop destination, that is the ISCID. So they can go to this court and they can settle their disputes. So this is what the BIT overall provides for in almost all the nations. Now coming to the India's BIT. The BITs were largely negotiated in India on the basis of the model BIT of 1993. So this was the basis on which we used to sign BITs. Then the government approved to revise the model text for the Indian Bilateral Investment Treaty in December 2015. Yes friends, the issue started from 2015 when government planned to revise these BITs. And recently, India has terminated its bilateral investment treaties with 57 countries and also issued notices to around 50 countries to terminate the BITs. Because of this modification, the old one has to be terminated. Yes friends, so in order to terminate the old one, 57 countries have been terminated and BITs with other 50 countries have been intimated to terminate. So this is the issue that is being raised by various foreign entities. Now, what does this new BIT provide? Why the voices are being raised? The new model clarifies that it only covers investments that have physical presence and substantial business activities in the territory of the host state. That is, if you have physical presence and if you have substantial business, only then BIT will give you the protection. If you don't have a physical presence and if your business is not so substantial, then you will not be having any benefits out of BITs. Then the investors get the significant benefits of ISDS or the International Dispute Settlement System, but not before pursuing prior remedies before the domestic courts. Or in other words, this clause says that before moving to the ISCID, you will have to exhaust all your chances in the Indian legal system. That is, you have to start from a high court, then move to the Supreme Court. There you have to appeal the Supreme Court once again. And even there, if you don't get justice, you can move to the ISCID. So you don't have an opportunity to reach the ISCID at the very first instant. So you cannot reach the International Dispute Settlement Mechanism at the very first instant. So this is a cause of concern for foreign entities, because it will be very dilatory to exhaust all their opportunities in India and then move to the international system, because they don't know what is the legal system in India, they don't have contacts of lawyers, and there are more chances of Supreme Court of India giving judgments in favor of Indian entities or Indian government. Then India's new model BIT makes clear that its goal is to accomplish more than mere investor protection. So I don't give you absolute investor protection. I want even the protection of domestic entities. I want domestic industries to grow. I want even the opportunity for retrospective taxation. That is the CERN India issue. So all these things have made the BITs murkier, and we are hanging in fire regarding the BITs. We don't know whether we terminate the BITs of older ones, whether we come up with the new ones, whether we come up with any innovation. So nothing of those is clear, and we will update as and when the issues come up. Now come to the next one, the advanced ruling mechanism in GST. Friends, the definition of advanced ruling mechanism under GST is that it means a decision provided by the authority or appellate authority to an applicant on matters of supply of goods or services to be undertaken. So this is something, an advanced ruling, that is, before the crime is committed, you are going to give the judgment, or in other words, you are taking the permission. In simple words, that is, if you are going to transfer a goods or services, you will go to this advanced ruling authority and ask that what should be my valuation, what should be my estimated tax, whether mine is a goods or whether mine is a service. Give me the judgment. So after it gives, then I will take that permission slip, and after that I can transact or I can transfer the goods or services smoothly. So you can say that it is a licensing entity, permitting entity, or you can say that it is an advanced adjudicating entity. So adjudication is done even before the crime is committed or the act is committed. Now the objective of advanced ruling mechanism, that is to provide certainty in tax liability in advance. So before you going to the tax officials and getting stuck there, you will be having a prior intimation. So with this advanced ruling mechanism, you will be having least glitches, least disputes and least conflicts. So your transfer of goods and services will go smoothly. So this smooth transfer of goods and services will attract foreign direct investments. Then ultimately it reduces litigation. Yes, we know that by advanced ruling, you are avoiding those litigations which have to be trialed and prosecuted and taken up after the crime is committed or after the mistake has been committed. Then question on which the advanced ruling under GST can be sought. So what are those things wherein you can sort the advanced ruling mechanism? That is classification of any goods or services or both. So what kind of transaction are you making, whether goods or services or what? Then time and value of the supply of goods and services. So what is the value of my service which I am being rendering, or what is the timeline due to which I have to render? So at what timeline I have to pay the tax? So all these are been amenable for advanced ruling mechanism. Then admissibility of input tax credit of tax paid or deemed to have been paid. So this input tax credit is also amenable to advanced ruling mechanism. Whether I have been amenable for input tax credit, whether my goods is a raw material for others, whether mine is an input for other industry. If yes, I will get the input tax credit, else no. Then determination of liability to pay tax. So whether my goods or whether my services is amenable or applicable for this GST tax, whether I have to pay the tax or not. So even in those areas, advanced ruling mechanisms can give judgments. Then come to next, the authority on advanced ruling. Friends, the section 96 of the CGST Act or the Central GST Act 2017, it defines the authority of advanced ruling as follows. That is, it says that authority for advanced ruling and the appellate authority for advanced ruling are constituted under the provisions of State Goods and Services Act or the Union Territory Goods and Services Act. Or in other words, each state and union territories, they have to set up this advanced ruling mechanism and the appellate advanced ruling mechanism under this SGST and UTGST Acts. Then the government shall appoint officers not below the rank of Joint Commissioner as members of authority of advanced ruling. So for authority for advanced ruling, the officials should be over and above the Joint Commissioner ranks. So these are the appointments for the state advanced ruling mechanism and appellate advanced ruling mechanism. Now coming to the center's advanced ruling mechanism. The center authority for advanced ruling will be constituted by the central government, and it consists of a chairman who is a retired judge of a Supreme Court and two members of the rank of additional secretary to the government of India, and that is one each from the Indian Revenue Service and the Indian Legal Service. So it consists of three members. One is the retired judge of the Supreme Court, and the other is the Indian Revenue Service officer, and the third is the Indian Legal Service officer. So this is the central advanced ruling authority, and this is the state advanced ruling authority. Here the commissioners and above rank will be appointed. Here a Supreme Court judge and an IRS and ILS officer will be appointed. So I hope you have got the difference. Then applicability. An advanced ruling pronounced by the advanced ruling authority or the appellate authority for advanced ruling shall be binding only on the applicant. This clearly means that an advanced ruling is not applicable to similarly placed other taxable persons in the state. So this ruling is specific to the applicant. If I am transacting a thing, and if that comes out to be a service, not a good, as per the ruling of this authority for advanced ruling, that ruling is only for me. If another person, if he transacts the same good and he cannot take it as service, so he has to once again appeal to the authority for advanced ruling, and he also should take the permission just like me. So this is the applicability of authority for advanced ruling and the advanced ruling mechanism. Then come to next one, the variable capital company. Friends, why was it in news? Because Dr. K.P. Krishnan Committee on Variable Capital Committee has submitted its report on the feasibility of variable capital companies in IFSC or the International Financial Service Center to the IFSC authority. So this authority has sought the opinion of the K.P. Krishnan Committee on whether the variable capital company has to be allowed within the International Financial Service Centers. So in that context, the committee has given the recommendation. Now we study about the variable capital company. It is a corporate structure that is tailored for the collective investment scheme. So chit funds, other collective investment funds, all this come under this variable capital company. Then under this, several collective investment schemes may be gathered under the umbrella of a single corporate entity and yet remain ring fenced from each other. So they can pool under one umbrella, but still they can remain separate. So this is a new mechanism for these collective investment schemes, wherein various groups they will invest the funds, but however they can act as a united strength. Then it gives funds an alternative to unit trusts, limited partnerships and limited liability partnerships and companies. So earlier these collective investment funds they used to pool their funds into unit trusts, then limited partnerships and limited liability partnerships, but they had their own drawbacks. So there we cannot identify ours as a separate entities, but here we can pool our funds, at the same time we can recognize ourselves as separate entities. So it gives an alternative to all these. Then it allows the sub funds to share a board of directors and have common service providers such as the same fund manager, custodian, auditor, then administrative agent. So almost all the managers of the agent can be one and the same for all those members who have pooled the funds. Then certain administrative functions like the holding of general meetings and preparation of prospectuses can also be consolidated. So almost all the administrative things can be consolidated and one entity can look after all those things. Then wherever a VCC is set up as an umbrella fund with several sub funds, then members may hold shares that are referenced to a particular sub fund held by the VCC. So if this is a overall umbrella fund, I can hold the shareholding of this particular sub fund. I need not hold those shares which are applicable to all the sub funds. So this particularistic shareholding is also available under VCC. Then coming to the recommendations of the committee recommended the adoption of VCC like legal structure for the purpose of conducting fund management activities in the IFSC. Or in other words, the committee recommended that VCCs or the variable capital companies they have the eligibility to conduct their businesses under the International Financial Centers jurisdiction. Then they also recognized that there should be a legal framework for governing these entities. So these are the legal frameworks that the committee recommended, that is certainty and clarity to investors. So what are the investments you are doing? Where are you are investing? Which stocks? What are the interests you are paying me? What are the profits? What are the taxes? So all these have to be clarified. Then effective segregation and ring fencing of different pools of assets. So you have to provide legally how you segregate the funds and how you ring fence among the various sub funds. Then the ability to issue different classes of shares. So whether you issue the common shares or whether you issue aggregated umbrella shares or whether you issue this quality institutional placement or the preferential placements. So all these have to be clarified at the earliest. Then alteration to funds capital structure without regulatory approvals and freedom to choose the appropriate accounting standards applicable to the funds with different characteristics. So here two things are there, that is the fund's capital structure should be allowed to be altered without the permission of the regulators, and also that the freedom should be given to choose their own accounting standards. Then ability to wind up quickly, that is they have to invest at the earliest and they have to make profits at the earliest and they have to make profits and give back the profits to the investors as early as possible. So these are the recommendations and these are the legal frameworks that are to be brought in to the VCC. Now come to the next one, Insolvency and Bankruptcy Code. Friends, why was it in news? Because recently the Insolvency and Bankruptcy Board of India has amended the Insolvency and Bankruptcy Board of India's Insolvency Resolution Process for Corporate Persons Regulations 2016. So these rules have been amended recently, and what are the key amendments? That is the resolution professionals will be required to inform the adjudicating authority about avoidance transactions of a corporate debtor. So these resolution professionals who are looking after the insolvency and the bankruptcies of different corporates, they have to inform the adjudicating authority whether those entities are being involved in those transactions that are intended to be done for the sake of avoidance of the taxes. So if any transaction are being done with the intent to avoid taxes, it has to be readily informed to the adjudicating authority by these resolution professionals. Then it requires the resolution professionals to intimate such details on or before the 140th day of insolvency commencement date. So within 140 days of commencement of insolvency, it is the duty of resolution professionals to inform the adjudicating authority that this company they have transacted this much amount with the intent to evade taxes. Then allows the resolution professionals to appoint any professional including registered valuers to assist them in discharge of his duties during the corporate insolvency and resolution processes. So if these resolution professionals, if they are busy, they can appoint their assistants, and those assistants can even be the registered valuers. So who are registered valuers, friends? Those valuers who evaluate the company's assets, and if they are registered under the Companies Act. So all those people can be appointed as assistants to these resolution professionals. Then it requires an insolvency professional to disclose all the former names and registered offices and their addresses so changed in 2 years preceding the commencement of insolvency. So if the company has changed its office addresses, then that has to be intimated, and along with that, the current name and the registered office address of the company also has to be intimated to the adjudicating authority. And then all the records that are concerned with the shifting of offices and the communications thereof also have to be reported. So these are the key amendments to the Insolvency and Bankruptcy Regulations 2016. Now coming to a brief account of IBC. So this Insolvency and Bankruptcy Code was enacted in 2016 to speed up the resolution process of failed businesses. Yes, we know that. Then the code stipulates that the resolution process to be completed in a maximum of 270 days. So many of the companies, they have got this resolution cleared within 270 days or within the first hearing. So this is the success story of IBC. Then in March 2020, the government raised the threshold of invoking insolvency under IBC to rupees 1 crore from rupees 1 lakh to save small and medium enterprises suffering from lockdown. So earlier, just 1 lakh rupee of losses would have been amenable for the insolvency. So if a company is suffering even 1 lakh rupee loss, they can come and take up insolvency. But however, this was raised to 1 crore rupees to save those MSMEs who are suffering due to lack of business activities in the wake of COVID-19 lockdown. So now only 1 crore rupee loss is amenable for insolvency. Others need not go for insolvency. Then the code creates various institutions. So what are the institutions? The first one is the insolvency professionals or the resolution professionals, a specialized cadre of licensed professionals to administer the resolution process. So these are the licensed professionals who look into insolvencies. Then insolvency professional agencies. The insolvency professionals will be registered with the insolvency professional agency. So this is the institute which registers the insolvency professionals, which stipulates the model code of conduct, and which promotes the insolvency professionals. Then information utilities. It is an information network which would store financial data like borrowings, default and security interests among other forms. So this is mainly an authenticator of information. So whatever the company has been doing, whether it is taking debt, whether it is giving interest, etc., are being stored authentically in these information utilities, and they have to be mandatorily set up according to the Insolvency and Bankruptcy Code. Then adjudicating authorities. The proceedings of the resolution process will be adjudicated by the National Company Law Tribunal for companies and Debt Recovery Tribunal for the individuals. So for individuals it is the DRT, and for companies it is the National Company Law Tribunal. Then Insolvency and Bankruptcy Board of India. This board will regulate insolvency professionals, insolvency professional agencies, then information utilities set up under the code. So this will look into almost all the institutions that are being set up under the Insolvency and Bankruptcy Code. Then this board will consist of representatives from Reserve Bank of India, then Ministry of Finance and Corporate Affairs and Law. So all these ministries, they will be having a representation in the Insolvency and Bankruptcy Code. So this is an overall picture of the IBC Code 2016. And now coming to the next topic, data localization. Friends, why was it in news? Because recently RBI has imposed restrictions on MasterCard Asia from issuing new domestic customers the debit cards, credit cards or prepaid cards in India, citing non-compliance in guidelines for storage data in India. So this company MasterCard Asia was not storing its data in India. So that is why RBI has barred the company from issuing the further cards in India or pursuing business in India in the future. Now, the data localization policy of RBI. The RBI's circular dated on April 6, 2018 on storage of payment system had asked all system providers who are operating a card network in India under the Payment and Settlement Systems Act 2007 to store all end-to-end transaction data related to their Indian operations in a system located within the country. So within the country, all the data related to the transactions and end-to-end transaction of data has to be stored. Then companies had to comply with these rules within 6 months. So 6 months was the time given. Then the reason was to protect the privacy of Indian users, so to avoid Cambridge Analytica like issues and also to address the national security concerns. And then the government also believes that mandating foreign companies to set up local infrastructure can boost their local economies. So if any foreign entity is storing data in India, that data can be used for further businesses by the indigenous companies. So this will help improving the local economies. Then the central bank wanted a single common data source to have an effective data storage system in the wake of growing digital transactions and frauds. So in the wake of growing frauds, if the data are stored in too many different places, then it is very difficult to track the frauds. But however, if all the transactions, if they are stored in one single entity, then we can easily track and trace the fraudsters. So this is one more advantage of storing data locally. Then all such card companies had to file a compliance report and an audit compliance report. So even this was not done by this MasterCard Asia. So that is why the RBI has barred MasterCard from issuing cards in the future. So this is all about the data localization policy. Now coming to the next one, the ITAT-E-Dwar. Friends, why was it in news? Because the Union Minister of Law and Justice, he had launched the e-filing portal for Income Tax Appellate Tribunal, or the ITAT-E-Dwar. So ITAT comes from the Income Tax Appellate Tribunal and E-Dwar, it is a gateway for Income Tax Appellate Tribunal. So that is the meaning of this ITAT-E-Dwar, and this was launched by the Ministry of Law and Justice. Then the key points are: the portal will enhance the accessibility in the day-to-day working of ITAT. So this will help the people to access the Income Tax Appellate Tribunal more and more. And this will also enhance the transparency and accountability, because all those issues which have been dealt by the ITAT will be published in this portal. Then it would lead to quicker disposal of cases. Yes, due to avoidance of movement, then due to avoidance of paperwork, etc., this will lead to speedy disposal of cases by the Income Tax Appellate Tribunal. Then it would enable the parties to file their appeals, miscellaneous applications, documents, paper books, etc. electronically. Then it provides digital courtroom, virtual hearings and mobile application providing judicial information. So all these facilities are also provided by ITAT-E-Dwar, that is digital courtrooms or the virtual courts, then virtual hearings or hearing via video conferencing, then mobile application, a mobile app will be provided, and that app provides for judicial information regarding the ITAT. So all these services are being provided by the ITAT. Then more about the Income Tax Appellate Tribunal. It is a quasi-judicial institution set up in January 1941. So this was set up way back in 1941 and it is before independence. Then it is specialized in dealing with appeals under the Direct Taxes Act. So this deals with the Direct Taxes Act. So this doesn't deal with the indirect taxes at all. Then it was constituted by virtue of Section 5A of the Income Tax Act of 1922. So this takes its origin from the Income Tax Act. Yes friends, we know that an income tax can never become an indirect tax. So it is a direct tax. Then its motto is Nishpaksh, Sulabh and Satwar Nyay, or in other words, bipartisan, easy and realistic justice. So these are the motto of ITAT. Then it is the oldest tribunal in the country. So this is the fact to be remembered. Then the orders passed by the ITAT are final. An appeal lies to the High Court only if a substantial question of law arises for determination. So yes, the appeals are allowed, but however, that has to involve a substantial question of law, else no appeals are allowed. So this is all about the ITAT and the ITAT-E-Dwar. Then come to next one, independent directors. Friends, why was it in news? Because SEBI has backtracked on its earlier proposal of dual approval system in appointing the independent directors. So what is this dual approval system? Who are those independent directors? We discuss. An independent director is a non-executive director. So he is not having any position in the executive board. So he doesn't manage any wing or any department in the company. Then he or she doesn't have any kind of relationship, material or financial, with the company. So she is not a shareholder in the company. Then a larger say of independent directors can prevent frauds, mismanagements and misgovernance. Friends, as these directors are not the shareholders and as these directors are not managing any departments, then there are more chances of these directors taking impartial and bipartisan decisions in favor of the law and in favor of the company and not in favor of the economic prospects of the director or the owner of the company. So that is why more and more independent directors will lead to more and more partial working of the company and more improvement in the company. And then coming to appointment of independent directors. an independent nomination and remuneration committee of the board screens candidates for the independent directorships. So there will be a nomination and remuneration committee in the board, and that committee will nominate or shortlist the independent directors, and those shortlisted independent directors are appointed just like other directors through shareholder voting by a simple majority. So each and every independent director who are shortlisted will be taken up and he will be voted out by these shareholders, and if he wins the majority, he will become the independent director. Then, in case of family owned companies, it is common to appoint friendly independent directors. So, who is a friend of the family, he will automatically become the independent director. But there is a flaw here, because he is automatically a friend of the owner and he will take the decisions which is pleasing to the owner, and he will never take impartial or bipartisan decisions. So, to avoid all these things, the independent directors and the position and the rules and regulation has to be strengthened. So, that is why SEBI had come up with the dual approval, but however it has backtracked. So, what was this dual approval? Why did it backtrack? We will see in the next slide. That is the dual approval system. SEBI in March 2021 proposed a dual approval system. Under this, the appointment of an independent director required the satisfaction of two conditions. So, what are the two conditions, friends? It is the approval by a majority of all shareholders. Yes, friends, we have discussed that a person has to get the majority of votes of the shareholders if he has to become an independent director. Then, approval of the majority of the minorities. So, this is a bit trickier. Friends, I am having a company and I have 75% of the shareholding there. And now it is all about my vote, which matters while appointing an independent director. So, if I vote in favor of that director, it is akin that the 75% of majority goes to his favor. But however, this is flawed, because at the end of the day, I'll end up getting my man or my woman into this directorship. But the new rule says that it has to get the approval of majority of the minorities, that is the majority of these 25%. So, majority of these people, that is, if there are 4 directors here and if there are some 14 directors here, so ultimately whom these 14 members vote is immaterial, but at least 2 members of these minority people, they have to vote in favor of that person if he has to become an independent director. So, this is the meaning of majority of the minority shareholders, or the shareholders other than the promoters. Then, in case of a failure, the company can propose the same candidate after a 90-day cooling off period. So, if a person, if he failed to get majority of the vote, then he can be proposed once again after a 90-day cooling period. And now, when he is proposed for the second time, he has to be approved by a special resolution of 75% of majority of all shareholders voting. So, now it is not 50%. In the second time, he has to get this 75%. Then, SEBI recommended the same dual approval system for removal of independent directors as well. That is, even for the removal of the independent directors, majority of all shareholders and the majority of the minority shareholders. So, these two conditions have to be met for both appointment and removal of independent directors. But however, voices were raised against these rules, and now the SEBI has taken back this dual system. Now, what is the system prevailing? The recent announcement says that appointment and removal of independent directors would be by way of special resolution than a simple majority. So, at the very first instance, you go for 75% of majority and you need not wait for a cooling period, etc. Now, this simple majority is gone and only 75% majority remains. Then, it made no mention of the dual voting system. So, now majority of the minorities is not there. So, instead of this dual, only one system is brought in, and that to 75%. So, now SEBI might have removed this dual system, but it has struck a balance by retaining this special majority or by stipulating 75% of the majority. So, this is all about this dual approval system rules. Now, come to the next one, the sovereign gold bonds. Friends, why was it in news? Because recently the Reserve Bank of India has announced a plan to sell sovereign gold bonds in 6 phases. So, this is the latest issue of sovereign gold bonds, and in this context, we study the sovereign gold bonds. Friends, sovereign gold bonds are issued by RBI on behalf of government. Yes, we know that. Then, they are government securities denominated in grams of gold, which are substitutes for holding physical gold. So, instead of you purchasing physical gold, you purchase these sovereign gold bonds. Then, in 2015, sovereign gold bond scheme was launched with an objective to reduce the demand for physical gold. So, there will be many people who buy the gold only for saving money or to save them inside their lockers. So instead of doing that, you buy the sovereign gold bonds, invest in the market. At the same time, you give benefits to the government as well. Now, gold bonds bear interest at a fixed rate of 2.5% per annum, an amount of initial investment which will be credited semi-annually. So, these sovereign gold bonds, they give 2.5% per annum of interest, and that will be credited once every 6 months or twice in a year. Then, if the gold prices rise, the investor will get the high prices plus 2.5% interest. So, this 2.5% interest is over and above the market price. So, friends, we know that the gold price will be hiking day by day. So, over and above the prices hike, you will get 2.5% interest. And if the prices of the gold comes down, then the loss will not be given to you, but a fixed payment of 2.5% will be given to you. So, this 2.5% is fixed, and over and above that, you will get the hiked prices only. Then, the minimum investment will be 1 gram with a maximum limit of subscription of 4 kg of gold for an individual and 4 kg for Hindu undivided family and 20 kg for the trust. So, these are the limits, minimum and maximum, which have to be applicable for the sovereign gold bonds. Then, come to more about these bonds. They can be used as collateral for loans from banks, financial institutions and non-banking financial companies. So, you can use this as collateral as well. Then, interest on the bonds will be taxable as per the provisions of Income Tax Act 1961. So, that is overall income of yours, including this sovereign gold bonds and the salary. If it increases 10 lakh rupee, then only you will get the taxes. So, that is how the Income Tax Act 1961 is applicable. Then, but the capital gains tax arising on the redemption of sovereign gold bonds to an individual has to be exempted. So, there is no capital gains tax in this sovereign gold bonds. So, only income tax you will pay. That is, overall income of yours will be amenable for taxes, not the capital gains tax arising from this sovereign gold bonds alone. Then, indexation benefits will be provided to the long-term capital gains arising to any person on transfer of bonds. So, if you are a long-term holder of these sovereign gold bonds, then your profits will be provided after adjusting to the inflation. So, indexed benefits means your profit will be adjusted to the inflation indices, that is the WPI, CPI and all others. Then, though TDS is not applicable on the bonds, but it is the responsibility of the holder to comply with the tax laws. So, TDS will not be cut while receiving the profits of sovereign gold bonds, but if you don't pay tax overall, then the tax officials will catch hold of you. Then, although the tenure of bond is 8 years, early redemption of bond is allowed after 5th year on coupon payment dates. So, if coupon payment date of your bond is on 26th March 2029, so you can redeem this sovereign gold bond on 26th March 2025 or 26, that is 5 years, but on the same date, that is the 26th March only. Then, the bond will be tradable on exchanges if held in the demat form and can also be transferred to any other eligible investor. So, you can also transfer the sovereign gold bonds in the secondary market. So, these are some of the facts regarding the sovereign gold bonds. Then, come to the next topic, the Uday Kotak Committee on Corporate Governance. Friends, why was it in news? Because in the wake of COVID-19, Uday Kotak, the head of the committee, he recommended a 1991 like reforms, that is a overhauling of economic system of India was recommended by Uday Kotak Committee. In that context, we discuss what was his committee recommendations. Now, this committee was constituted in 2017 under the chairmanship of Uday Kotak. Then, the aim of the committee was to improve the standards concerning corporate governance in India. Then, the key recommendations of the committee are reduction in the maximum number of directorships in the listed entities from 10 to 8. So, earlier it was 10. The committee recommended a maximum of 8 member of directors in any listed company. Then, expanding the eligibility criteria for independent directors. So, the eligibility for independent directors should be expanded so that diverse people can be involved as independent directors like chartered accountants, auditors, then corporate specialists. All these people should be given an opportunity to participate as independent directors. So, that is why the eligibility has to be enhanced. Then, enhanced role of audit committee, nomination and remuneration committee and risk management committee. So, the roles of all these committees should be enhanced so that audition will be proper, then the nomination of directors will be proper, then remuneration will be on time and it will be fair and impartial, and then risk management committee will rise to the occasions and solve the problems whenever the company is in trouble. Then disclosure of utilization of funds from quality institutional placements and preferential issues. So friends, basically the funds coming from these QIPs and preferential shares will not be disclosed to the government, and that will be used as per the whims and fancies of the company. But the Uday Kotak committee says that even these funds have to be disclosed. Just like you do in the initial public offer and the follow-on public offer, you have to disclose the funds of QIP and preferential shares. Then disclosures of auditor credentials, then audit fee, then reason for resignation of auditors. So whatever you are doing with the auditor, everything should be disclosed, and most importantly, the reason for resignation of an auditor should be disclosed, because more often than not these auditors will resign only when there will be some fraud in the company, and these people are not willing to go against their ethics in order to hide those frauds from the government. So that is why the recommendation. Then friends, we have seen in the journey of UPSC that several aspirants, they spend money profligately, and more often than not you shuttle from your home place to Delhi or Bangalore cities with a wastage of money. So we know that one flight back and forth costs 10,000 rupees. So friends, try to save your parents money. Try to achieve your goals with minimum resources. So that is the greatest gift you can give for your parents. Just because your parents are capable of spending, do not try to suck up all those money. Mind you friends, almost all your parents will be at the age of retirement. So maximum success with minimum resources should be your motive. So maximum success and minimum resources. So remember that. Do it. All the very best. Good luck friends.